Welcome to the Private Equity Exchange, the only summit bridging the gaps between limited partners, private equity funds, corporate executives, and entrepreneurs. With over 1,000 delegates, the Private Equity Exchange is the only venue where LPs, private equity firms, corporate executives, and entrepreneurs meet. Before the events, using our internet platform, schedule one-on-one meetings with delegates that matter most to you, and exchange far more than business cards at your deal meetings at the Private Equity Exchange. Gather great market insight with over 120 speakers and 6 tracks to choose from. The Private Equity Exchange, the largest private equity event in Europe for CEOs, funds, and LPs. You are looking at LBO for professionals, industry structure change, the liquidity revolution, lasting trends, and the next decade. Introducing
Good morning, ladies and gentlemen. Those of you who were here in the earlier comments from Javier and from the earlier panel have taken already a look at developments in the private equity world. We are looking today in the next hour at liquidity in private equity. Liquidity in private equity, and for that matter, publicity in private equity, are actually oxymorons. Javier said it this morning. Private equity is private, and private equity has traditionally been illiquid. That's why premiums are being paid, and that's why high returns, amongst other things, in private equity are being made. Now, for years already, there is a silent revolution underway, bringing liquidity to this market, and that is called the secondary markets. More recently, we also see liquidity coming in the primary markets, and that is through listed vehicles and other developments. KKR comes to mind, Apollo, but earlier Standard Chartered and other houses have been using that market to add liquidity on the primary side. Today, we have a panel here of secondaries specialists who have either secondary firms behind them and or primary firms. So I think we can take a look at it from both sides, but with a gearing towards secondaries. And I'm very, very pleased to introduce to you, beginning here on my left, Greg Holden from Adam Street, François Bernardeau from Headway Capital, Benjamin Revillon from Alp Invest, and Sabine Schäfer from Evolvence Capital joined us here on the panel. We're looking at liquidity in private equity with a brief excursus into the secondary markets. For those of you who have or who are in private equity but not necessarily in secondaries, we'll take a brief look at the trends and the drivers, the main actors, the LPs, the sellers, the buyers, the GPs, and then we look at deal structures, developments, and also at liquidity in private equity in general. Rather than introducing the panelists here and reading about their backgrounds, etc., we thought I'll give you a brief introduction by everyone. And perhaps, Greg, we'll start with you, and you're giving us an overview of Adam Street Partners.
My name is Greg Holden. I'm from the secondaries team at Adam Street Partners. Adam Street is a dedicated private equity investor with 3 main groups: a fund of funds, a secondaries team, excuse me, and as well as a direct investment team. Just to give you a little bit of history, Adam Street was founded in 1972 as a direct venture investor, focusing primarily in IT and biotech. And then the fund of funds was developed in 1979, and that has grown to just over $12 billion in assets under management. Adam Street in the secondaries market has been there since the beginning, since 1986. We were a pioneer in the market, involved in some of the first secondaries deals. Throughout the 90s, we grew with the market on an opportunistic basis, primarily through our extensive GP relationships through the fund of funds. And now we have a dedicated secondaries team, and that's occurred over the past 4 or 5 years. And we've built that up to have a broad range of transactions, from large portfolios of LP positions to direct investments. The secondaries team has access to over $1.5 billion in capital, and we are currently investing just over $300 million on an annual basis. As you can see from our pretty picture up there, Adams Street employs an integrated approach with the three teams, the primary partnership, fund of funds, the direct team, and the secondary team working very closely with one another. And we found that this is actually a great asset for our secondaries business as we can access the direct team for due diligence and the valuation of assets. And also the fund of funds team is a great resource for its ability to assess GP quality as well as a blind pool risk when necessary. And that is a brief overview of our secondaries.
Thanks, François.
Yeah, thank you, Olaf. François Bernardeau, and I'm with Headway Capital, based in London. Headway Capital was founded in 2004 by three young people that had known each other at Kohler Capital, spun off from Kohler Capital in 2004, and raised a fund in 2005. And I recently joined them as senior advisor. And I'm coming from Natixis Private Equity, the French private equity group, where I co-founded the secondary business. What you can see that all of us have very deep experience in secondaries for a few years or many years. What we provide is a full range of secondary solutions, buying LP interest, portfolio of directs, tail-end portfolio, and even single positions. Very flexible in terms of solution we can bring on the transaction. Geographically, both US and Europe. The fund is a 52 million euro fund, so we are on the smaller size transactions. But we have a unique base of investors. They are only family offices, which has three advantages: discretion, money for bigger deals that we can bring together, and value-added partners. So typically, if you can remember one thing, we are, in the securities world, the niche player.
My name is Benjamin Révillon. I'm investment manager at Alp Invest Partners based in Amsterdam. Alp Invest is one of the largest private equity asset manager in the world with currently 31 billion euros under management, entirely dedicated to private equity. We are currently investing an 11 billion fund. Our business model, as you can see on that slide, is really an integrated business model where we feed the primaries through co-investment, secondaries, and vice versa. And it's driven by primary relationships, but it works the other way around. We get invitation for co-investments, or we get the opportunity to buy a fund on a secondary basis and establish a relationship with a GP, and then we can invest in the next fund. In terms of setup, if we just start with co-investment, we can do a ticket size up to 250 million in one single transaction. On the secondary side, we can do anything between 10 million and 1 billion euros. And there we have quite a good access to capital. We have flexibility. Since we were in so many funds, we can be extremely discreet and swift at doing executions. Last but not least, some people claim they are vacuum cleaners. We are not vacuum cleaners. We are a good buyer of quality assets for which we pay big premiums.
Yes, good morning again. Sabine Jeff from Evolvence Capital. I had actually a slide on us up in the last panel, and I just want to quickly orally summarize. We are an alternative asset manager out of the Middle East. We are based out of Dubai. We were founded in the year 2000 by somebody who used to run ADIA's Abu Dhabi Investment Authority's North American arm for about 10 years, Mr. Khalid Al-Muhari. Evolvence Capital is actually owned by 13 high net worth families from the region, from Saudi, Kuwait, Abu Dhabi, and Dubai. And we do so kind of play the role of a GP as well as LP at the same time, as in we do make investments for those families, and we also have our own fund products. In particular, our focus is the Gulf as well as India. And when it comes to India, for example, we have the first independent India Fund of Fund, which is a 250 million fund, which is going to be closed by the end of this year. And we also have a direct fund in the area of life sciences that actually is run by the former gentleman who opened up McKinsey's life science practice in India. That's pretty much it. So I'm kind of here, I think, on the panel more to talk to you about the experience on the primary side.
And 2 or 3 words about Hedges Capital in New York. It was established in 1999 as a private equity investment business, and we've developed it in the meantime to the largest buy-side agency for private equity secondaries. That means we are working with the private equity buyers, the investors either represented like private equity secondary buyers here on the panel, larger insurance companies, banks, asset managers who have next to their primary also secondary capabilities. And we originate transaction and or search transactions, both limited partnerships, in other words, investments in MBO, LBO funds or in venture funds, but also direct investment portfolios, that is venture portfolios with direct stakes in operating companies. The firm's independently and privately owned. We about have been involved in a deal flow in the neighborhood of 1.5+ billion and have worked on 75+ funds in the transaction. It's a highly discretionary business, and from that perspective, we obviously have a very good view on the market. Now, Hedges Capital is also a placement agent in the alternative asset field, and obviously from that segment, we have quite a view or a take on the primary side and on the liquidity in the market. Let me, to introduce into our topic, briefly take a look at the secondary market. The secondary market today is a 30-40 billion market. The level of funds raised in the last year, the transaction volume, as you see on this slide, was 10 billion. In a historic perspective, this is still a fairly young market. The secondary market was really accredited, or going back to Dayton Carr and the Venture Capital Fund of America, which in the early 80s, with funds from Tom Watson, privately invested into small startup firms, and buying secondary investments in small startup firms from existing investors. That was, with I believe $1 million at that point in time, the secondary market. The market in the meantime has morphed, as you can see, and particularly the takeoff has happened since the year 2000. Is a rule of thumb, secondaries follow the primary markets with a time lag of about 3 to 5 years, and on average 5% of the primary market. If you're looking at the primary markets in private equity, 2005 was just shy of 300 billion of funds raised in private equity funds. This year, I think we're going to exceed 600 billion in primary funds. And as you can see in the previous slide, the level of secondary transactions and the commitments to secondary funds has been increasing ever since. So that industry, when we were making predictions in the year 2002 and 2003, we thought we might get to 5 billion or maybe 8 billion. As I said, this is about a 40 billion volume industry at this point in time, and the funds, the secondary funds, raise annually around 5 to 8 billion. This year, Benjamin, is going to be, what, another 8 billion a year, I think, for the year 2006?
Depends of color, hard cap.
Okay, the two large ones. But in any case, that's the level of the industry. The principal drivers behind the industry are really liquidity for primary investors. In other words, opportunities to sell an illiquid investment in a private equity fund at what is ever more becoming transparent pricing, so that you as a primary investor have the opportunity to come out before the life of the private equity fund matures. With that, it is a liquid function to the market, and I think before we start really with the secondaries, Greg. If you want to take a look at the LP perspective, as most of the investors here in the room probably identify best with that.
Sure. I think before I get into specific reasons or rationale why sellers are currently selling, it might be beneficial to give a brief history of the secondary market from an LP's perspective. If you go back to the early days, so to speak, in the mid to late 80s, a lot of the transactions were being performed on a discrete basis. And this was in an attempt to avoid an embarrassment factor, because back then a lot of the deals were performed because LPs might have been wanting to get out of a poorly performing fund, or they were having problems meeting their capital calls. In this situation, the GPs were actually acting as intermediaries, very involved in the transaction, again, to keep it discreet. And typically, they were being sold to existing LPs within the fund, therefore keeping the transaction in-house, so to speak. And, of course, in this situation, the LPs were in a distressed situation usually. Moving to the 90s, individuals and firms began to recognize the opportunity in the secondaries market. You had a big, significant change with the emergence of secondary specialist firms such as Lexington, Landmark, and Collar. And what these guys were doing was proactively attacking, some would say, but proactively approaching the LP community looking for potential sellers. And by going directly to the LPs, avoiding the initial contact with the GP. Another major change was the market was moving away from just transfers or sales of single interest of LP positions, but also into larger portfolios. And this is where we began to see some of the huge portfolio deals in the secondary market. As the market matured, the industry the secondary market has become an industry all on its own, as the numbers that Olaf just went through will attest to. It's basically a large and growing market, as is the primary private equity market, which it lags. I think one of the biggest indications of the maturity and the stability in the market is the increase in intermediaries and the prevalence of auction deals in the market. This has led to efficient pricing, but also to increased competition. One of the, I think, the positive things about this is as the market is matured and become more stable, we're seeing a change in the type of sellers in the market, or I should say a change in the rationale for selling. As the market has developed and as sellers have become more comfortable and knowledgeable about the market, they're actually approaching the market and see it as a respectable and a great mechanism for actually achieving liquidity for their own strategic objectives, as opposed to just being distressed sellers, as was the case in the late 80s and early 90s. Therefore, sellers, as you can see from the slide, sellers are using the secondary market to meet strategic objectives and to manage portfolios, as opposed to just being distressed sellers. If we move on, I think one of the best ways of going through the rationale why sellers are currently selling is to break it out by transaction type. The four main or basic types of transactions in the secondary market being single positions of limited partnerships, portfolios of limited partnership positions, direct investments, and also corporate venturing portfolios. Starting with the single LP interest, the sellers tend to be high net worth individuals, family offices, as well as institutional investors. And although in the past, and still to a certain degree now, a lot of the rationale for selling was short-term liquidity, people, again, maybe having problems meeting capital calls, I think it's become other reasons as well. Some of those reasons relating to issues or events within the funds themselves. For example, a member of the investment team departing, or disappointment on behalf of the seller with regard to investment pace. Those are just two examples of a myriad of reasons why people might want to, why LPs might want to sell their single positions. Moving to the portfolios of limited partnerships, again, one of the reasons for selling could be to achieve short-term liquidity, but I think more and more it's for strategic reasons. For example, a pension fund having a change in its target allocation to private equity, or a corporation looking to dispose of an orphaned group of private equity assets that it acquired in a merger. Another reason in this camp is regulatory pressures. A lot of institutions are having limits put on the level of illiquid assets they can hold on their books. So that's also a driver in these types of transactions. With direct investments, these have really come to the market in a big way in the last 4 or 5 years. Typically being sold by institutional investors and most commonly through financial institutions and banks. And what these guys did was they would develop a private equity group within the institution itself, a captive group, and now they're looking to exit the asset class, so the groups are spinning out. And this happened, a lot of the big banks have done this, Dresdner, Deutsche Bank, JP Morgan, and this happened in a big way in 2002 to 2004 time period, primarily because of a nervousness from the institutions with regards to private equity due to a huge fall in valuations in 2000 and 2001, but also for regulatory reasons as well. The final transaction type that I want to discuss is corporate venturing portfolios. These are similar to direct investments, but what these are is where corporations have either acquired or developed a portfolio of assets for strategic purposes. For example, the development of an industry-specific technology. One of the first well-known deals of this ilk was in 2001, the acquisition of technology assets from Lucent Technologies by Collar Capital. But this is becoming more and more common recently, and two examples would be portfolio sales from the Atomic Energy Authority of the United Kingdom. And I think as corporations look to dispose of non-core assets for cost-cutting and outsourcing purposes, I think we're going to see a lot more of these transactions in the near future. Now, I've spoken a little bit about why sellers are selling. I'd like to spend just a brief amount of time on why you would want to buy. Some of the advantages of secondary investing. The first one here you can see is increased diversification. I say type and time. What I mean by this is in one transaction, you can acquire multiple positions with exposure to a number of geographies, type of underlying private equity deals, as well as vintages. The number two reason here, although it's probably the one that's the most quoted, is the muted or reduced J-curve effect. And just for those of you who may not know what the J-curve is, it's an illustration of the natural progression of cash flows in a typical private equity fund. So from day one, you'll have negative cash flows from management fees and from capital calls for investments, and then eventually trending positive from the realizations, thus the J-curve. With what secondaries does is it allows for the fast capital deployment because you're buying into a later stage in the fund, you have less unfunded commitments. Also, early return to capital because you're buying in a later stage in the fund, the assets you're acquiring are a more mature stage. Another reason, good risk-adjusted returns. In a secondary deal, you can acquire a portfolio that has much less, if very little, blind pool risk, especially when compared to a primary private equity investment. Another advantage is opportunity to balance or weight manager exposure. And what I mean by this is in a secondary deal, you can increase your exposure to either a specific or a group of GPs based on your current view of them without having to wait for their next fundraising. Increased scope for market intelligence because you get a broad access to GPs and underlying private equity transactions. You really gain exposure to a wealth of market intelligence in an efficient manner. And now, finally, how to buy. I think there's probably three main ways that you could do this as an LP. One would be to increase your holdings in an existing portfolio, probably the easiest and most obvious way. The second way we have up here is to actually invest directly in a secondaries fund. And I'm sure that François and Benjamin will agree that this is probably the best and most effective and efficient way of gaining exposure to the asset class.
I disagree, we don't raise third-party money.
And I think the third way here is to set up a dedicated secondaries team of your own. This is obviously the most difficult and most involved way of doing it, and as deal sourcing and valuation are critical, it's very key that you get the right people to drive the business. So with that, I will pass it back to Olaf.
Yeah, and just as one point here to what I said earlier, what Greg just explained to us in a summary is that the secondary markets today offer a myriad of opportunities for investors for very different reasons to sell or to buy investments in the private equity world. And that's for one of the players, and that is the investors as limited partners. The other players who have access to this market or benefit from this market are the general partners in their fund. And François will take a brief look at the general partner level on that one.
Yes, I will look at from a GP perspective, and I will be, of course, addressing myself to particularly to the GPs that are in this room, and I see some of them I've known for some years. I think typically the GP resent any secondary transaction, any LPs coming to him saying, I would like to sell my interest in your fund or my co-investment position along you. And clearly, it's not because the LP is distressed, it's not because the asset is not good. Maybe it's just because the LP want to free up some money, put some money in the next fund of the GP. Maybe the assets are good and the LP know they can be priced fairly and nicely, so I think it's a good asset to sell. And nowadays we see a lot of LP transfer even in the best funds, and it's very now normal to do such a thing. Now, what is the GP role into such transfer? I think the GP has a duty to his LP, helping them selling those assets. And clearly, the GP can benefit from this transfer. Why? Well, secondary transaction is replacing an LP maybe leaving the private equity market, with a new player, a new investor, that could be an investor in the next fund. So it's really, you know, having somebody which is not interested in you or which is leaving the world of private equity with somebody that is much more interested and motivated. Secondly, having discussion with secondary buyers can be a good marketing opportunities. You can meet with groups, like maybe my colleagues here that have both primary and secondary money, or like us at Headway, we have investor, family offices that can look at those funds on the primary side. Let's say that just by going into a secondary transaction ourselves, the funds will get onto the radar of our investors. Liquidity can be a very good selling point because we all know private equity is illiquid. If a new future LP knows that sometime down the road, when the fund is a little more mature, 3-4 years down the road, he will have an exit with the secondary market, and it's very important for him. The last thing a GP can benefit from a secondary transaction, of course, is a staple transaction where the buyer of the LP interest will also commit to the next fund of the GP. Very beneficial for the GP trying to raise his new fund, maybe less beneficial to the LP selling because the prices might not be the best. Anyway, how will the GP be involved? Let's say that if the LP decide to sell his interests in the fund or his co-investment position, not by himself, not by an intermediary, he can come to the GP and ask him to help him. And clearly the GP can be of help finding potential buyers, either referring the opportunity to an intermediary, which of course would give access to more buyers, or refer the opportunities to potential buyers directly, or to people like Olaf that are working for those buyers. This means more discretion, a quicker process, and clearly for the GP, a chance to choose his next investor. Now, we all know that the GP sometimes might be a little awkward about giving information to the potential buyers. I would say a few things on that is that discretion is coming from typically from the NDA that has been signed by the potential buyers. especially if that potential buyer is in a dependent secondary group only dedicated to secondaries, maybe not in a group that is doing direct investment. Second, the GP can feel, why should I give all that information to this guy I've never met? And, I don't give that to my other LPs. Well, two things. The other LPs don't ask you, so, but clearly they could ask you the information. And second, the LP is asking the GP to give that information to the potential buyer. So I think there's no asymmetry there. Last but not least, the GP is involved. He has to give his consent for transfer. And typically, we have seen a few GP that refuse to give consent, and clearly, we don't think it's a good thing. It's not a good thing for the seller. It's not a good thing for the potential buyer. And we don't think it's a good thing for the GP himself. We're not sure it's a good thing for future LPs. Now, why would the GP go directly to the secondary market? And this is, of course, typically in the case of all the funds, after all the assets have been invested, most of them are sold, are exited through IPOs, trade sale, whichever. There are a few assets remaining, little value. It takes time, effort, cost, administrative cost, investment monitoring, because the GP still has to go to those boards to follow up on those companies. All that for very little value. So he's left with one choice, which is extend the life of the fund, trying to sell those assets, which is non-efficient. Distribute the assets to the LPs, listed or worse, unlisted. And typically the LPs don't like that, because they're ending up with a very small piece of asset and they don't know how to manage that. It's not their business. Third, going through a secondary transaction and sell all the assets, one block to one seller. And this is typically the most efficient way, because then all LPs get their money back. It's eliminating cost and effort and work for the GP. And the GP is free to concentrate on the fund that is just starting or on the way of raising. All this, what it all boils down, really, secondary transaction is something that helps the GP make his LPs happy. And I think that's the GP's ultimate goal.
Yep. Yeah. And that's actually what François was just telling us about the tail end. Coming back to the early 80s or even in the early 90s, that was one of the original functions of the secondary market. It was serving for the GP universe to enable them to take their eyes off their existing funds as they were entering past the harvest stage, the tail end stage, and really looking at the new funds. Benjamin, you will take a look at liquidity options and recent developments in secondary transactions, and then we'll look a little bit at the primary liquidity end from there.
Sure. The thing is, like, as much as the secondary market has matured, transactions have become more and more structured and sophisticated. We have the classic straight sales of LP interest. And I mean, if I just take a step back, I mean, on the bottom of that slide, you see that some of these transactions just generate cash proceeds, and some transactions allow or don't allow for synthetic transaction. And here, what I mean by synthetic is a seller can keep the relationship. So let's say a leverage finance bank still want to have the relationship with a particular GP, but can sell the economical interest into that fund. So you can structure it in a way which is called a synthetic. Or here it's what I refer as synthetic. So, and you see that we go from minimum transaction complexity to maximum transaction complexity. I will just dive in directly on the next slide, please. Straight sale of an LP interest. This is a transfer of ownership of the portfolio to one or number of secondary market buyers. This is a traditional transaction. This can be structured in two very simple ways. One, which is first one is to have a deferred payment, i.e., the seller gets his proceed into 2 or more installments. As such, he can achieve a higher pricing from, let's say, IR sensitive buyers, i.e., people who are not who are IR constrained and they are ready to pay a higher price if they can pay in 2 or more installments. Another tweak to that straight sale will be to have a seller financing. So, I mean, that speaks for itself. The seller is going to provide a loan at a cost to the buyer, and this will be priced in. These are like, let's say, the secondary trade of yesterday, today, and tomorrow, plain vanilla with a little bit of tweaks, very simple. Then we have something, we have a new, let's say, advent in secondaries. And this is like example of transaction that we at Alp Invest have done this year, either alone or with other players, but it's like really off the shelf from this year. And we're not aware of transaction of this kind done before. First one is a profit-sharing joint venture. In that case, the seller can bring his portfolio to a structure in which he will keep an equity interest. The buyer will pay for those interests, cash amount or not. But what will the buyer do? He will fund the future unfunded commitments. So the future capital calls will be funded by the buyer, as well as potentially some future new commitments. So you can see a structure where, the seller brings his portfolio, is going to reduce his exposure or not, or actually, I mean, he's going to immediately or in different way. So he can get cash proceeds now, but he can also keep the exposure to the underlying assets. And it's pretty tricky, but it can be quite interesting. And it allows for a lot of flexibility so you can achieve the seller needs. New type of transaction are collateralized fund obligation. They already have a nickname or an acronym, which is CFOs. And i.e., this is a CFO is going to be an amount of debt raised against a pool of private equity assets. So you got a debt package, and it's collateralized by private equity assets. With that structure, you can go for full-fledged securitizations with rated notes. It's a lengthy and expensive process, but the reward are twofold. One, the debt instrument is going to be cheap, like 30, 50 basis points over LIBOR, and you can go up to 80% leverage. The other one, which is a non-rated debt, will be slightly more expensive, like 120, 150 basis points, but it's much more flexible. i.e., if you had issued a rated instrument, you have to live with it, and you can't change much. With a standard debt package, you can talk to your banker and rearrange things as things goes. And this is particularly interesting for let's say very sophisticated investors that want to optimize the return of their portfolio. And it's as much as the GP do releverage their investments. This is like a leverage or releverage of your existing asset pool, and you create equity value while you pay down your debt, and it's a simple leverage recap principle. The last new type of deal, and that we haven't done ourselves, I have to admit, and I don't think anyone has achieved that yet, but maybe some have. I know that a lot of people have thought about that. It's equity swap. Simple name, but a very complex transaction. Here, the buyer is going to offer in exchange for a portfolio either interest in his fund, in his secondary fund, or in an interest into a existing asset pool. So you bring your portfolio and you get a 10%. I mean, you bring a portfolio of 100 and you get 10% off a new asset pool of 1 billion, and that could be done either as like you get an LP interest, or you could get eventually shares into a listed vehicle. The tricky part there is like the buyers need himself to form a view on the value of the assets he's getting into, i.e. you bring your 100 and you've got 10% off a listed vehicle or a defined fund. You need to form a view on, you know, what is going to be worth to you in the future. So as much as, you know, when you got a company merging with another one and the shareholders end up with the other company shares, you know, they need to make a call, and are they going to sell these shares now? If it's a listed vehicle, it's possible. If it's a limited partnership interest, it's not possible. So these are new trends, and we really see a development in secondary markets where it's becoming more and more sophisticated. It's becoming more and more accepted, has been said by my colleagues, to sell, but also to optimize your portfolio. And you can now do a lot of things that not a number of transactions in which you will keep your relationship with the GP, or retain the existing asset, but not have to fund the future commitments, or you can, you know, just recap that, and it's quite interesting.
First of all, I have to apologize again. I was asked quite last minute to join this panel, so I won't have any slides available. However, I wanted to share with you a little bit the point of view from kind of a primary fund, which at the end of the day also should be of interest to my colleagues here, given the fact that when it comes to emerging markets, I mean, we are at the end of the day the people who provide the secondaries with, you know, what they're going to bring on the market. And so from that point of view, I think what I would like to kind of point out is simply, as was done before, advantages, disadvantages for GPs and LPs, and what primary funds in particular have to be kind of watching out for. So again, I think it's quite clear for an LP what is the advantage of kind of listing primary funds. On the one side, I think when you talk about the classic private equity, the two issues that always come up is A, liquidity, and B, the amount of capital that people are normally supposed to put into funds. And normally excluding a lot of people who are not willing to go into something below, let's say, $10 million. I think by having a listed vehicle, you obviously take away those hurdles, and in addition to that, you find advantages such as, you know, a higher transparency. You all of a sudden see, you know, an NAV level, which, as we all know, for a private equity fund is something quite difficult normally to do, and for an LP, also quite difficult to find. And last but not least, I think for an LP, having access to some of very sought after funds, primary funds as well, is something that's again an advantage. And here I just want to point out, for example, SVG, who put up a vehicle on the London Stock Exchange, and who actually has about 25% of that goes to the Premier Fund. So basically, people who are going into that vehicle all of a sudden do find access to a Premier Fund, which again in itself I think is quite attractive. Now, from a GP point of view, why does a primary fund want to list? Again, not that different from what was mentioned before from my colleagues. Obviously, first of all, you make it easier when it comes, you know, we're talking about an evergreen capital, so we're talking about kind of certain ease when it comes to fundraising. You don't fall into those fundraising cycles. It is also, because of the transparency that now exists with the vehicle, it's also easy actually to leverage in comparison to a non-private equity fund. And then in general, simply if you are a primary fund already and if you want to widen your LP base for the reasons that I mentioned to you before, you kind of do find more investors that might be interesting for your product. Now, what are the issues that come with that? Normally, and this is also actually what we did saw with the big ones, like for example KKR, those vehicles sometimes tend to actually be traded below NAV level. For different reasons, but mostly comes back to the issue about capital deployment. So obviously what is very important for any primary fund to things of listing is to already have, let's say, a decent kind of deal flow channel, so where the money can get deployed quite quickly early on, that would normally help to kind of get a certain buzz as well around the fund, and should help actually that the fund itself is going to be trading above NAV. Otherwise, you can also obviously have clauses in, such as buyback clauses, where the fund itself can put in a security, as in if, for example, the fund trades, let's say, 10% below NAV, the fund managers would have the possibility to buy back the shares. Last, what I just kind of want to say as a final comment is that for me, this whole, let's say, development represents nothing else but another step as a merger between hedge fund and private equity funds, as in you kind of realized over the past couple of years that hedge funds kind of coming from, let's say, traditional kind of, knowing how to structure finance, going more into also the management side, and now the pure private equity players that are now trying to actually become more liquid, and so kind of more, let's say, move towards the kind of a hedge fund criteria, let's say. And I think that is quite interesting, and I do believe that also we do see less and less of kind of, let's say, club financing, and I do believe that kind of the listing vehicles is going to be definitely a growing area. Thank you.
Thank you. Thank you, Sabine. Talking about hedge funds, this is a total different subject on convergence into private equity, but I was still amazed the other day on a similar panel. Was a GP of a hedge fund, was asked by the audience, what do you do in private equity? And his simple return comment was, yes, we are investing in private equity. What about liquidity? Well, if there's a problem, we're going to the secondary markets. True, as a secondary market player, the secondary market is deep and can handle those transactions, but not totally true either, because hedge funds basically think in days or in hours. The private equity world and the secondary world more things in weeks, months, or in some instances even years. So there is still some improvement to look at. Ladies and gentlemen, any questions to any of the panelists here at this point in time? What I suggest, to keep this on track and on schedule rather than expanding with some questions and discussion amongst us, I think we had a great overview of both the secondaries and some issues on the start of the emergence of the liquidity on the primary side. I think, ladies and gentlemen, we want to leave you with a conclusion here that at least on the liquidity element in private equity, significant progress has been made. Some of the issues that came up here, like transparency, I think we've seen some progress there, but at the same time also publicity is an active debate that is only happening now. We see this revolution in our industry. But in a nutshell, on the secondary world, there are deep pockets, there are sophisticated transaction levels, and there are an increasing amount of players who provide this service to the industry. On the primaries, that is, I think, subject for another topic, which will also look at transparency at that point in time. On behalf of all the panelists here, thank you for your attention and interest, and to the panelists, thank you very much for joining us here on this morning's session.